The broadcast is now starting. All attendees are in listen-only mode.
Okay, sorry guys, sorry for the delay. The software is a bit cranky this morning, but I hope everything is fine now. I suppose everyone can hear me and see the slides right now, right? Okay, I'll carry on then. Okay, just to go back to where I've touched on earlier on, we were talking about Capital Land Retail China Trust, the results for the last quarter. And for the last quarter, they have seen gross revenue increase about 4%. And this is driven mainly by the malls located in the more central Beijing area, mainly Xizhimen, Wangjing, and Grand Canyon. NPI also rose partly because forex movements moved in CRCT's favor, in that the RMB actually strengthened against the Sing dollar. So what we saw over the last quarter is that we saw tenant sales remaining pretty strong. Tenant sales went up about 18% year on year, despite the fact that traffic footfall was almost flat. So we think this is because the of the proactive leasing strategies from the management. This could have contributed a lot to the strong tenant sales that we see quarter on quarter each time, because the management has been always actively looking to pull in the popular brands and the the better selling brands in China. And we can see that also from their decision to bring in the leading fashion retailers into two of their malls, and that actually led to negative rental reversions for two of their malls, because in trying to get in Tommy Hilfiger and Uniqlo to two of their malls, management guided that they actually offered some discounts to entice the retailers to go into the mall. So if we strip out these effects from these negative rental reversions from these two malls, we actually see that rental reversions stayed around at 10% for the last quarter. So I think a big question on investors' mind now could be, given the current turmoil in the stock market, would that have a big impact on retail spending? And as to what management sees on the ground right now, they do not see much of an impact. So these results that I've shown are for until June. And for July numbers, in fact, management has not seen a big impact yet. And in fact, for July, the footfall actually increased month on month as well. So for the debt headroom for CRCT, they actually still have a 2 billion debt headroom for acquisitions. In terms of the tenant sectors that are doing well and not doing well, supermarkets and department stores are actually the laggards since many quarters ago. And as for the strongest sectors, the F&B and the fashion sectors, these are actually still doing pretty well and recording a 10% increase year on year growth in the tenant sales. And lastly, management also guided that in view of all the increase in the number of mall operators in China and increase in competition from not only the conventional sources of retail outlets, but also you see competition from the non-conventional sources such as e-commerce. So in view of all this fact, management guided that it is very likely we would observe a flight to quality as the number of mall operators increase. So in Capital Land, we have this very established brand operating in China, and retailers will tend to gravitate towards malls which are able to, carry out marketing events or align the mix of the tenants in the mall such that they would be able to optimize footfall in the mall and subsequently increase tenant sales. So we should see a gravitation of retailers towards this stronger mall operators, and this is actually a good thing for Capital Land Retail China Trust. So next I'll pass on to Lin Xin to talk about OSIM and Sheng Siong.
Hi everyone, this is Linsin. I will be taking over consumer as well as healthcare sector. So for this quarter's earnings, please bear with me for probably some late reportings as I'm trying to understand the companies more. Yep. So for last week, we have actually published two reports on OSIM as well as Sheng Siong. So for OSIM, okay, quarter on quarter, they we see some profit improvement as U-Magic sales help to drive sales. And for this second quarter, right, about 58% was derived from the North Asia side, and the management continue to see trend as such, where OSIM aims to develop more TWG stores within the region, and 38% are derived from South Asia, and the remaining are from the rest of the world. And more than 60% of the revenues are actually contributed by sales of massage chairs. So as you can see that massage chairs plays a very important role in OSIM. And as we know that U-Magic has actually been launched in April in Singapore, Taiwan, Hong Kong, and Malaysia. As for China's market, they have actually just recently launched in the end of June. So what we can see here, right, is actually just the contribution that captures the other four core markets. We have yet to see the U-Magic sales contributed from China market. As such, we are expecting a better second half for OSIM. As the U-Magic will continue to gain traction, especially in the China market. And also, we will be seeing that more small ticket items, the new massage sofa, U Diva Classic, should be launched in probably at end of third quarter or probably early fourth quarter. So this would also help to boost sales for OSIM, and it should be priced at about 2,000 Sing dollars, where consumers are most price sensitive at. Also, we have also seen GNC has just launched their new product, and management is actually very optimism for the second half of the year, mainly also on the back of a brighter prospect in China economy. Anyway, just to on the book side, we will be seeing that sales will remain soft, as well as the legal fees, higher operational costs, and startup costs of TWG should be weighing on the bottom line throughout the year. And TWG expansion plan is still on track. They have actually opened 3 stores as of end of the first half. One in Changi, T3, Terminal 3, one in Guangzhou, and one in Shanghai. And they have actually opened another one in end of April in Bangkok. Yeah, so sorry. So just to rephrase that, there are total of 4 new stores open as of end of the first half. So they are targeting to open another 11 new outlets in the second half, and they are looking at North Asia, mainly in Hong Kong, Macau, and Shanghai. And I think probably for those who are actually following OSIMs are aware that they have just recently acquired minority stakes in the Hong Kong-based cosmetic company, the LDPRL, sorry. Yeah, so these cosmetic companies, they would be launching, they will be selling these tea extract skincare products, and they have also, and OSIM also has actually acquired a minority stakes in Track 2000 as well. So probably we will be seeing some potential technological synergies. Okay. Moving on Sheng Siong. So For Sheng Siong, we have actually seen four new stores open in the second half, and the most recent one would be Punggol, Bukit Panjang, and Pasir Ris. All these are HDB leases, and they are open in April, May, and June respectively. And in for the for the second quarter, we can actually see that the same store sales growth are actually quite flat. This is they have actually gone from 2.9% in the first quarter to 0.3% in the second quarter. So this is actually mainly due to competition intensify as all the retailers, which includes NTUC as well as the dairy farms, are actually fighting to attract footfall, and also they are doing um, a lot of promotions in conjunction to the SG50 celebration. And also we see that there are some underperforming stores in the mature housing estates. So there are 5 key stores which actually contributes about like 6 to 7% of Sheng Siong's turnover, and two out of the 5 key stores are actually underperforming. So what the management are currently focusing on is to revive the footfall for these old stores. They are going to continue to renovate old stores, and while they are renovating these old stores, they are going to install this self-payment system. The self-payment system would actually help to enhance customers' experience. By accelerating payment process. It's also going to help Sheng Siong to save costs, as well as enable them to redeploy their human resources to new stores so that it won't restrict growth in the new stores. Management also guided that they are going to continue on margin enhancement initiatives, mainly to continue on bulk handling to capitalize on their Mandai distribution center, and hence we should be seeing a lower input cost as well. And also they are on track to shift their sales mix to more of producing the higher margin fresh food products rather than groceries. Hence, we should be able to see that the gross margin should maintain stabilize at about 25%. A slight update on the JV with Luchen Group in Kunming, China. So the management are saying that they could be opening their first store towards the late of this year. They've actually registered this JV company in May 15, and they are ready to inject capital at about Sing dollar of 6 million, probably in next month. And they have actually narrowed down to 2 locations, and they are negotiating on rental and yet to finalize the deal. So with that, just to conclude everything, I'll just like to say that we have actually lowered our target price from $1 to 96 cents on higher EPS for this year, and also a lower P ratio of 25 times rather than the 27 times which we have used earlier, mainly due to a more competitive economic landscape in Singapore. We should see that competition in the supermarket industry to remain, and also a tougher outlook in the property market as we see higher rental reversion, as well as more competition for retail space for expansion. So with that, I would like to pass on the presentation to Richard.
Good morning. This is Richard speaking. Okay, I'll start with SIA Engineering. So they announced their results last week. As you can see, the revenue is about 6% lower. This is due to lower airframe and component overhaul. What they are saying is that now with the newer aircraft, they are more reliable and they require less maintenance, and so the cycle between their maintenance and overhaul periods has lengthened, and that's why the aircraft are not going into the hangar at the same frequency as before. The other thing that's being affected is their engine MRO segment as well, which you will see in the associates and joint venture line here. It was down 21% year on year. This was attributed to a decrease in engine repair and overhaul. This comes from their JV called Cecil and their associate called Eagle Services. So Cecil does the MRO for Rolls-Royce engines, while Eagle Services does the MRO for Pratt and Whitney engines. So consequently, PATMI was down 13% to 41.3 million compared to 47.7 million last year. This is an adjusted number which excludes a one-time restructuring gain in the first quarter of last year. Okay, so we move to the first bullet point. As I mentioned earlier, this is one of the long-term headwinds for them, which is the aircraft. Aircraft being more reliable, requiring less maintenance, fewer tasks and longer intervals between the checks. And second bullet point, which I also talked about, was the engine reliability. So these two factors combined is a derating catalyst for SI engineering. Third bullet point about associate companies show sign of stabilization. So Eagle Services is one of their associate companies. So despite having the weaker year-on-year performance for Eagle, but in aggregate, their associated companies showed a marginally higher profit at 0.2 million. So I think that this shows some sign of stabilization in this aspect of their business. To conclude for this slide, we maintain our reduced rating for SIA Engineering and with a target price of $3.43. Moving on, SMRT. SMRT also announced their results last week on Thursday evening, and there was the briefing on Friday morning. So there was largely no surprises in the results. I'll walk you through from the revenue side down to net income. So for revenue, we split it into fair business and non-fair business. Fair business, you see that revenue was up 6%. This was due to ridership growth and higher average fare. Ridership growth was in MRT and bus. So consequently, revenue for the group was up 7.8% as most of their business segments had revenue growth. For fair business at the operating level though, this is their second consecutive quarterly loss. Bus was profitable, but the loss from MRT and LRT dragged this part of the business down to be unprofitable. Non-fare business was up 3.6%. This came from contributions from profit from their taxi operations and the rental segment. So rental is where they rent out the shop space within the MRT and bus network. So as a result of the lower fare profits from fare business, the operating profit for the group was down 5.4% to 27.7% and net income 21.1 million. So largely profitability for the group has been affected by their increase in staff costs and R&M for repair and maintenance. What we see is that staff cost, depreciation, and R&M will increase further going forward. These are due to the hiring of more train drivers and bus captains. Depreciation is due to a larger train fleet, and so there's more PP&E on the books. And um, R&M due to the tightening of um, operating standards and maintenance of the aging network. For this quarter, SMRT guided that their taxi business remains stable. The fleet rental is a high 98%, and they said that they are not seeing any material impact coming from third-party taxi booking apps. Downtown Line Phase 2, DTL2, will be opening in December this year, and this could be a threat to the North-South East-West line, as ridership could be diverted from North-South East-West line to DTL2. DTL2 is not operated by SMRT, it's operated by SBS Transit. The DTL2 actually runs parallel to one of the sections of the North-South East-West line. You can view the map of it in the report that was published last week. It's on page 2. Okay, now moving on to the main part of today's presentation, I'm going to present on the industrial subsector for S-REITs, because this is the reporting season and the industrial S-REITs have completed their reporting. So I'll talk about what we have seen this quarter and update you on the individual portfolios. First up will be industry aggregate data from JTC. I have 3 bullet points here. The first one talks about occupancy. So occupancy is quite healthy at 91%. It was up 0.3 percentage points both quarter on quarter and year on year. This was mainly driven by high occupancy in the warehouse segment. While occupancy was stable, but prices and rentals softened due to the increase in supply of space. And at the present moment, latest update is that 1.6 million square meters of new space is coming up in the second half of this year. This is what the S-REITs are saying during this quarter, during their results briefings and through their press statements. First thing, the S-REITs are saying that they did not have to give additional incentives in order to retain tenants, and the incentives were in line with market practices. What these incentives are is that when the REITs try to retain their existing tenants, they will give them some form of discount. The discount would be in the form of 1 to 2 months of rent-free for a 3-year contract. Second bullet point is that they are saying that it's going to be a challenging outlook. This is due to pressure on rentals and occupancy coming from the large supply of industrial space that's coming online in this year and next year, 2016. So they are expecting that rents will ease further due to this strong supply, and in conjunction with the JTC subletting rules of the 70-30, where you need to have a qualifying anchor tenant for 70% of your space. However, the bright spark that they are saying is that they are expecting rent for business park and high specs buildings to increase due to the limited supply. So this is our investment ideas for the industrial REITs subsector. So firstly, for business park space, since it's going to be in short supply and there are no new spaces after 2016, we think that this would result in strong demand for this segment, and there will be a possibility for positive rental reversions. So we currently cover Soybuilt Business Space REIT, and we have a buy recommendation on it with a target price of 96 cents. For the warehouse segment, we are advocating to be selective. So choose a portfolio of warehouses with good locations and superior design. So in our coverage, we have Cash Logistics Trust. The other last two bullet points, we are just highlighting some REITs that are not in our coverage, so we do not have any official rating or target price for it, but they do have exposure to certain themes. So for the third bullet point, um, what the S-REITs are saying is that there are certain industries within the industrial space where there are high growth with strong fundamental demand, and they gave an example of data center. So if you are interested in data center, you can consider Capital Data Center REIT. Um, high specs buildings, they're expected to outperform due to limited supply and tend to have better quality tenants high up the value chain. So as REITs with exposure to this high specs buildings would be Ascendus and Mapletree Industrial Trust. Okay, this is a graphical representation of what I've said 2 slides ago. So the first two is the aggregate industrial sector in Singapore. This is the JTC data. So the top left corner, what you see is the occupancy for industrial space, the aggregate industrial space. Top right corner is the rental. So you can see that rental on aggregate has fallen both year on year and quarter on quarter. Bottom left corner is a factory occupancy. You can see that it's remained flat, roughly flat, and rental also has fallen a little bit quarter on quarter. Business park occupancy has ticked up 85.3%, which is higher than the last 2 years on average. Rental index roughly stable, and then bottom left corner, warehouse occupancy has gone up both quarter on quarter and year on year, and rental index has roughly stable, but it's down 1.3% year on year. Now this is a snapshot of the 10 industrial REITs, some of their key operating metrics. So the first one, the top left corner, is the portfolio occupancy. So you can see it's been ranked from highest occupancy to lowest occupancy. You can take a look at it and assess the desirability of their properties through their portfolio occupancy table. Next is their WALE. So this is the mean time to expiry for their remaining leases. Bottom left corner is their balance sheet gearing, and bottom right corner is their debt maturity. So you can use this to assess their exposure to the rising interest rate environment and how long they are prolonging their debt rollover. Now this is the outlook for the subsector, industrial subsector. What this chart is showing is the supply. This is the JTC data for supply of each of the 3 types of industrial space all the way up to 2019. So the blue bars are showing factory, orange bars warehouse, and the green bars the business park. So first bullet point is the industrial space for 2015 and 2016, the new space, is about 10% of current existing stock. So if you add these 6 bars here, or sorry, this first 3 is about 1.6 million, and this second 3 here is 2.8 million square meters. So the current existing stock is about 43.5 million square meters, and these two, so for 2015 and 2016 is about 10% of existing stock. So what we're expecting is that there will be further downward pressure on occupancy rates due to this new supply, and the new supply will probably exceed demand as well. This additional space coming on stream is significantly higher than the average annual supply, which had been around 1.5 million square meters in over the last 3 years, while demand over the last 3 years has been about 1.1 million square meters. We think that there will be a downward pressure on rent for factory space, mainly due to the supply side. Next bullet point, 1.1 million square meters of warehouse supply, but about 73% is pre-committed. So this pre-committed is through probably built-to-suit projects, so there's already a tenant. So what the actual real supply that's coming out is the remaining 27%. Next bullet point, we are expecting demand for business parks to remain healthy as qualifying tenants gravitate from the city to business parks. So I'll point out here that there's no planned supply from 2017 onwards. You don't see any green bars here anymore. And so tenants who do qualify for business parks would want to move from the city to business parks due to the cheaper rent. Rent in the city is in excess of $10 PSF per month, while business parks would range between $3.50 to $6 PSF per month. In this environment of a large supply, we also think that qualifying anchor tenants will have the most bargaining power. Qualifying anchor tenants are those who satisfy the JTC criteria and meet the 70-30 rule. Now we have a last few slides. So how we would go about assessing vacancy risk for the industrial REIT portfolio. So first what we do is we list out all 10 of them, and then we see what is their exposure to the Singapore supply demand dynamics. So we see that out of the 10 of them, actually 2 of them are not so dependent on the Singapore supply demand dynamics, which are MLT and KDC. For MLT, it only has about 37% of its properties in Singapore, and KDC is 42%. 5 of the REITs have all their properties in Singapore, and the remaining 3 a majority in Singapore with some exposure overseas. Now we zoom into the lease expiry profiles for those 8 S-REITs that have significant sensitivity to this supply-demand dynamics for 2015 and 2016. So these are the 8 of them, and they have been ranked by combining the 2015 and 2016 lease expiry. So what this table shows is, for example, if we look at this first line, 2% of cash logistics tenant will be expiring their leases in 2015, and then 15% in 2016, and so forth. So if you add all these numbers together, you should get 100%. And what we have done in this final column here is to add the percentage of lease expiry for 2015 and 2016 together. Why we are focusing on 2015 and 2016 is because this is the period where there's a lot of supply coming up, and so we want to see what is the lease expiry profile for this period for the S-REITs. This page is a graphical representation of the previous table, so you can use it to assess where are the so-called risky portfolios where, in 2015 and 2016 there's a lot of supply, and then you would try to avoid the portfolios where there's a lot of expiry exposure during this period. And this is the last slide. So earlier we mentioned about business park and high specs buildings and data center. So the industrial S-REITs, they say that they're expecting rent for these segments to increase due to limited supply, and also these are some of the high growth areas. So the chart on the left shows some of the S-REITs with exposure to business park space, and this is by percentage of their own individual portfolio, by portfolio value. And the chart on the right is for S-REITs with data center and high specs buildings in their portfolio, and this is again by percentage of portfolio value of their own individual portfolio. Okay, so we've come to the end. We'll welcome your questions now. Hi, this is Richard speaking. There's a question on how long will SIA EC continue to face headwinds? Yeah, in the previous quarter, the management actually said that they expect to see more input for the engines in 2017, because that's when the current stock of engines is due for their first servicing. Can repeat the last slide. Okay, so this is the last slide. In the earlier part of the presentation, I said that what the industrial S-REITs are saying is that they're expecting rents for business park and high specs buildings to increase due to limited supply supply, and they're also saying that there's interest in growth industries such as data centers. So the chart on the left is showing S-REITs with exposure to business park space in their portfolio, and the chart on the right is showing the S-REITs with exposure to high specs buildings and data centers in their portfolio. Hi, this is Richard speaking. There's a question, is Keppel DC REIT the same as Keppel REIT? No, the two REITs are different. Keppel DC REIT is a portfolio of data centers. Keppel REIT is a portfolio of office buildings.
Hi everyone, Tahong here. There's a question on how will S-REITs be affected by rising interest rates. So as we've mentioned before, now a lot of these S-REIT managements, they have been very prudent on their balance sheet. Not only are they limited by the general ruling that they cannot go below 45% gearing, a lot of them actually started hedging their debt to fixed rate debt since a long time ago. Like for instance, you look at Capital Land Mall Trust, right? Since a few years back, they've been hedging a huge portion of their debt to fixed rate debts. And right now we're looking at a lot of REITs, because not only are we wary of the fact that interest rates are going up, the S-REITs management, they're aware of this fact as well. So a lot of them have already started hedging a huge portion of their debt to fixed rate debt. And what this means is that as long as you do not have any rollover of your debt, if you keep a constant gearing, you do not have any rollover, your interest cost is going to be stagnant. Unless you have to, let's say for next year, you have a rollover of your debt, then your new interest rate will start to kick in. So that being said, as long as the REITs do not have any rollover, the debt cost of debt will not go up. And we we also know that the as we moved along from the 2000s, to 2007, where we had this good growth and initially the low interest rates were low. REITs actually had pretty low gearing ratios at the start. That was when a lot of REITs started to IPO, like for instance when First REIT IPO'd, they had actually a gearing of 0. So when you have low gearing, your debt is cheap, and let's say you acquire a hospital at 10%, you use full debt to acquire it. It's easier to make accretive acquisitions. But right now we see that gearing ratios for a lot of REITs have gone up over the years. Interest rates are going to go up, so it wouldn't be as easy for REITs to make accretive acquisitions. So we advise clients to do a very bottom-up approach to picking REITs, because we think there are still pockets of strength in certain sectors, and look at the picks that we advocate, we think that the growth drivers are still there. Hi, De Hong here again. There's a question on the debt maturity for REITs. So I was saying that as long as they don't roll over their debt, the cost of borrowing is going to remain the same. So the question is, someday, somehow, all REITs will have to roll over their debt, right? And then when they do that, the interest cost is going to rise, right? And the short answer to this is yes, it is, right? But then, as we have mentioned, we think that interest rates are going to go up, but interest rates are going to go up at a very, very gradual pace. That's number one. And when we look at interest rates going up, when they do hike rates, right, that is actually on the back of the fact that they think that the economy is recovering. And in such a macro scenario, when you have economies recovering, you're looking at businesses expanding, people getting wage growths, consumption increasing, and then hospitality might get a boost from there as well. So in such a general better macroeconomic conditions you're looking at, you actually can get better. You're looking at maybe like better reversions from your rental, from your leases, from your office renewals and your retail space renewals. So it's a it's a it's a kind of you get interest rate hikes, correct, and your interest cost is going to go up, correct, but you are also looking at better general macroeconomic environment where you might be able to get stronger reversions, and that will actually offset the higher interest costs. And this is exactly what we saw from 2002, 2003 to 2006 and 7. In that period of time, interest rates were going up, but there was strong growth in the property sector as well. Alright guys, if there's no other questions, we will end our webinar today. Thank you for your time today, and we hope you will tune in again next week. Bye.